We begin in China, where a surge in COVID-19 cases has forced the government to slap social restrictions on vast portions of the population. The world's second largest economy has just emerged from its worst outbreak since 2020. It was a crisis that leaders chose to confront with a use of strict lockdowns, even as the rest of the world learns to live with the virus. Now, officials in Beijing are trying to chart a path to a steady recovery. Paolo Montesilio reports.
Off comes the closed sign, and on come the lights. This cafe in the trendy part of Shanghai is back open for business. Its owner is hoping for a steady stream of much-needed customers after a COVID-19 lockdown.
The impact was huge. We only have this shop, and we don't sell our products online, so we weren't able to do any business during the outbreak.
Other firms in China's busiest metropolis are already waking up to better sales. They say after 2 months stuck at home, millions in the city are raring to make their presence felt.
Today, the lunch orders came in early from white-collar workers returning to work. They're excited to eat out on their first day of work. We started preparing at 6 in the morning.
We're seeing some pent-up spending, which is normal because people have been held back for such a long time, around 2 months. Everyone is looking forward to going out.
The reopening of restaurants and shopping centers should give the Chinese economy some relief. Latest available data show retail sales in the country fell 11% in April, the month lockdowns began. Other industries also felt the pain. Factory output shrank for the 3rd straight month in May because workers were stuck at home and supply lines were backed up. Local officials are confident these industries can rebound quickly with the easing of restrictions.
A total of 2,021 firms from the industrial, trade and service sectors in the Baoshan district have resumed business and production. Some 62,000 employees have returned to their posts.
The national government is eager to help the recovery along. Beijing is rolling out the stimulus package that includes tax cuts, higher spending, and other forms of financial support for small businesses in Shanghai and other major cities. It's exactly the kind of jolt they need. Paolo Montesilio, TRT World.
Well, let's get more on this now with economist Taha Arvas, who's also adjunct professor of finance at Bogazici University. Good to have you back with us as always, Taha. Can I start with the situation in China, because it is becoming increasingly clear that the Chinese economy is facing significant headwinds, partly because of its zero COVID policy, which is still locking down large parts of the economy as much of the rest of the world learns to live with the virus. Can you tell us what impact is that having on the Chinese economy domestically?
It's a major impact. China in the past was only considered an exporting country. Consumer spending wasn't a big deal. In the last decade, consumer spending in China has tripled, and consumers have become much richer. And when these policies, as you know, China very successfully weathered the pandemic, but only recently has been having issues with it. When the rest of the world is almost finished with the pandemic, China is having the surge. And that has very much slowed consumer spending. There are other side effects. People who live in China, especially high-tech workers, are making plans to move from China in some aspects because they're afraid of the continuation of these policies.
Now, in terms of the knock-on effect that's having on the rest of the world, we know that a lot of countries rely heavily on imports from China. We consume Chinese goods voraciously. What impact is that having on those countries that do import a lot of Chinese goods? Does that run the risk of perhaps rising inflation as Chinese manufacturing slows?
Absolutely. I mean, the lockdowns that we saw, both the lockdowns that are currently in China and the global lockdowns slowed supply chains. And just when the world was opening back up, China continued to lock down and the supply chains have been constricted. That means things have to be flown instead of shipped. That means producers are paying more to get things done quickly or move them elsewhere. So all of these effects will have major inflationary pressures both in China and for its consumers, the rest of the world.
Let's look at the conventional antidote to rising inflation, and that is raising interest rates, making borrowing more expensive. We know the US Fed has kickstarted a series of interest rate rises. It says more are to come, but we know that does run the risk of perhaps prompting a recession, and that's some leaders say that perhaps is inevitable. If you want to bring down inflation, you have to slow down growth, and a lot of people are predicting a global economic slowdown. Do you agree with that? Do you see that happening as well? And is that really the first and only thing that can be done to bring down prices?
That's what it looks like is going to happen. The Chinese central bank recently was expected to potentially either increase rates to slow inflation or decrease them to help spur the economy, which it needs to do now because of this slowdown in spending, especially by consumers. But it did neither recently. It left rates unchanged because it's trying to figure out where exactly the economy is going. Will it be able to weather these recent lockdowns? And so what's happened is the Chinese currency is also very volatile recently. And China and the rest of the world is looking to the Federal Reserve for what it's about to do. So most recently, the United States had new unemployment numbers come out and an increase in payrolls across the board, which is good news for the economy specifically. But that means that the Federal Reserve will be more active in increasing interest rates, albeit only by 50 basis points every meeting. But ultimately, if that continues, if they continue doing that by the end of the year, all other countries, including China, will feel pressure to keep the pace. And that's going to slow growth in their countries, in China, as well as the buyers of Chinese goods abroad.
Now, as you pointed out earlier, inflation was already on the rise because of supply chain disruptions caused by the pandemic. But now we're seeing sharp rises in the prices of food and energy because of the war in Ukraine. How much is that conflict having an impact on global inflation right now?
It's a huge impact. People ask me, what do you think are going to happen to the price of tomatoes, for example? And I say the price of tomatoes is very much tied to the war in Ukraine. And they say, how is that possible? Well, if the war in Ukraine continues, if the conflict in Ukraine continues for another year, 2 years, 3 years, the world's largest exporter of oil is not going to be able to export as easily as it did. We've seen new restrictions by the EU and other countries that are preventing Russia from selling their oil, which means supply is less, which means the price of oil will increase, which means the price of getting those tomatoes from the farm to your table is much more expensive. So that's the biggest question right now. And China is an energy importer. China doesn't have the oil to export. It's a net huge energy importer. So the conflict in the Ukraine will very much affect the price of everything we consume that comes from China, smartphones and all these electronics, textiles, etc. So our pocketbook, the world's pocketbook, is tied to the price of energy for the Chinese economy.
Okay, Taha Arvas, we'll have to leave it there, but really good to get your analysis as always. Thank you.
My pleasure.